Hey everyone, welcome back to the channel. In today's video, we are diving deep into a fascinating article that was published by the Economic Times in May 2023. It highlights 44 superstar stocks that gave mind-blowing returns of over 1000% from 2014 to 2023. That's right, 1000%. Over the next 15 minutes, we are going to break down what made these stocks stand out, the common trends and strategies behind them, and how you can apply the lessons from the winners to your investment strategy. If you are curious about which companies made this list and what you can learn from this explosive growth, you are in the right place. So let's get started. Let's take a closer look at some standout stocks from the list. These companies have delivered massive returns by reshaping industries and adopting innovative strategies. Tanla Platforms lead cloud communications, KEI Industries excels in wires and cables, and Uno Minda stands out in the automotive sector. Electra Green Tech thrives in electric vehicles, while Naveen Fluorine and APL Apollo Tubes lead in chemicals and structural steel. Balaji Amines, JBM Auto, and KPR Mill have capitalized on chemicals, auto parts, and textiles. Bajaj Finance, Bajaj Finserv, and Cholamandalam dominate financial services, with Trent and Timken India excelling in retail and mechanical components. These companies highlight key strategies driving success. Let's deeper dive into them. High ROE. One of the standout features of these 44 superstar stocks we are discussing today is their exceptional return on equity, which on average exceeds 20%. This is a significant indicator of the financial health and operational efficiency of the companies. ROE measures a company's ability to generate profits from its shareholders' equity, and an ROE above 20% generally signals that the company is efficiently utilizing its capital to deliver high returns. What's even more impressive is that many of these companies have sustained high ROE over long term, which is no easy feat in today's competitive market. This consistent performance reflects strong management, strategic decision making, and the ability to capitalize on growth opportunities. When you see a company maintaining such a high ROE, it often points to a competitive edge in its industry, efficient operations, and a business model that maximizes profitability. For investors, a high ROE is a key metric to look out for when identifying a potential multi-bagger stock. It shows that a company not only knows how to make the most of its resources, but is likely to continue generating substantial returns, contributing to long term wealth creation. High earnings growth. These companies have consistently delivered massive earnings growth, delivering their multi-bagger performance. For example, Tanla Platforms and Bajaj Finance have seen annual growth rate of 30% and 25% respectively, reflecting strong market demand and operational efficiency. KEI Industries and Naveen Fluorine has grown earnings by 18 to 20% annually, capitalizing on energy infrastructure and chemicals. Electra Green Tech has posted a 40% rise driven by India's electric vehicle shift. In the automotive and textile sectors, JBM Auto and KPR Mill have posted steady 20% growth. I think you get the point. Overall, these companies' strong and sustained earnings growth has been a major driver for their success as a multi-bagger stocks. PEG ratio. The PEG price to earnings to growth ratio is popularized by legendary investor Peter Lynch in his book One Up on the Wall Street. It measures a stock's valuation by dividing its price to earnings ratio by its earnings growth, helping investors assess whether a stock is overvalued or undervalued relative to its growth. A PEG ratio of 1 or below is typically seen as desirable, as it indicates that a stock is reasonably priced relative to its earnings growth potential. A lower PEG suggests the stock is undervalued based on its growth rate, making it a more attractive investment. However, when the PEG ratio is above 1, it doesn't automatically disqualify the stock. For example, if a company is growing at an exceptional rate, a slightly higher PEG ratio can still be acceptable, especially if the growth prospects justify the premium. As we saw that the stocks on our list, an average PEG of 1.8 is still manageable compared to the Nifty 500's average of 1.4. Ultimately, a PEG ratio should be used in conjunction with other matrices like ROE, revenue growth, and industry trends. While a low PEG ratio can indicate a bargain, a high growth company with a higher PEGs might still offer multi-bagger potential as long as the growth prospects are strong and sustainable. Lower debt to equity ratio. The debt to equity ratio is a key indicator of financial leverage. And for multi-bagger potential, a low DE is generally preferable as it suggests financial stability. Company like Gainwell Norton, Linde India, and Abbott India showcase extremely low debt levels, which help maintain stability while supporting long-term growth. Similarly, low debt levels can be seen in others as well as demonstrating how minimum debt can be a strong foundation for success. In contrast, Bajaj Finance and Cholamandalam Investment, both part of the financing industry, have higher PE ratios, which are a bit on the higher side in comparison to the industry. Financing companies often rely on debt to fund their lending operations, and these higher ratios reflect their ability to leverage debt effectively while maintaining profitability. Overall, a lower debt to equity ratio is ideal for most sectors, but in industries like finance, due to their lending nature, generally we see a higher DE ratio. The key is ensuring that the company maintains strong earnings and a solid risk management framework to handle its leverage. High operating profit margins. Operating margin is a critical indicator of a company's profitability and efficiency, showing how well a company can generate profits from its revenue after covering operating costs. Companies like Bajaj Finance, Bajaj Finserv, Cholamandalam Investment stand out with exceptionally high margins, indicating their ability to generate significant profits from their operations, particularly in the finance sector where the efficiency is the key. Linde India and Abbott India demonstrate the strong profitability while Grindwell Norton, Mastec and Timken India also showcase strong margins. Overall, companies with higher operating margins like those in finance and chemicals demonstrate strong financial health and efficiency, a key characteristic for a multi-bagger potential. Higher promoter holdings. Promoter holding is a crucial factor in determining the stability and growth potential of a company. Higher promoting holdings often signal strong confidence from the management and key stakeholders, which can be an important driver for long term value creation. Vinati Organics, Trident, and Patanjali Foods have significant promoter stake, which typically translates into a higher degree of control and strategic direction, ensuring directions that align with long term stakeholder value. On the other hand, companies like Coforge, Sonata Software have much lower promoter stakes, indicating lesser control from the management, which might not always align with the long term growth strategies. Although these companies can still be successful under strong leadership. Overall, high promoter holdings are a strong indicator of management confidence and they tend to align the investors to key stakeholders to those investors, which is often a hallmark of a multi-bagger stock. So, to sum it up, the 44 superstar stocks on this list all share some key fundamental matrices that you should watch for when searching for a potential multi-bagger. First, ROE, above 20%, signaling efficient capital use and robust profitability. Second, earnings growth of 20 to 30% annually, demonstrating sustained and robust growth. Third, a PEG ratio, a PEG ratio of 1 or below, indicating that the stock is reasonably priced for its growth potential. Fourth, a debt to equity ratio as low as 0 to 1 to 0 to 3 is ideal for most sectors. But in the financial service sector, ratios around 3 to 7 are acceptable. Fifth, operating margin. Above 20% are a good indicator of operational efficiency and profitability, especially in sectors like finance and chemicals. Sixth, high promoter holdings. Ideally, above 50% of reflecting management confidence and alignment with shareholder interests. By keeping these desirable numbers in mind, you can increase your chances of finding stocks with multi-bagger potential. However, these matrices alone are not the holy grail. There is still a need for deep research into other crucial factors like forensic analysis, industry trends, shareholder disputes, or even recently legal or regulatory cases surrounding the company. All these elements contribute to a thorough evaluation before making any investment decisions. Thanks for tuning in, and if you found this video helpful, don't forget to like, comment, and subscribe. See you in the next video.